A fall in demand for vacation homes, a shakeup in a power buyer's IPO, racial disparities in lending, and a rise in federal interest rates. From PropLogix, these are your top 4 real estate stories this week. Redfin released a report this week sharing that the demand for vacation homes fell dramatically in February, hitting the lowest level we've seen since 2020. Demand went from 87% above pre-pandemic levels down to 35% above pre-pandemic levels. There's probably no shock to anyone familiar with the FHFA announcing an increase in fees starting in April ranging from 1% to 4%. This, tied with rising mortgage rates and home prices, are having second home buyers reevaluating their need to buy a place of residence in more seasonal towns where they vacation. 𝗏, the power buyer that allows home buyers to compete with cash offers, announced a layoff of nearly half its workforce, plans to cancel their IPO, and $220 million in new funding from private investors. They say their goal with the layoffs is to become more profitable by the end of the year. The capital, they say, is much less than what they were previously hoping to raise in their IPO, leading them to right-size their business and lay off approximately 115 employees. The company plans on providing employees let go with 5 years to exercise options, and some are being helped by 𝗏 to apply at 𝗟𝗟𝘂𝗏, their competition. During the refinance boom, Wells Fargo approved fewer than half of black homeowners' refinancing applications, compared to 71% from all other lenders. This isn't the first time that Wells Fargo has been caught in the limelight for racial disparities. In 2012, they paid more than $184 million to settle claims that they charged black and Hispanic homeowners higher fees and interest rates after unfairly steering them into subprime mortgages. When Bloomberg reached out to Wells Fargo for comment, they didn't dispute these refi numbers, claiming they treat all of their potential customers the same and have a more selective process for approving loans. On Wednesday, the Federal Reserve raised its target federal funds rate by 0.25 percentage point from near zero. This is the first increase in 3 years we've seen, and there are 6 more expected by the end of the year. How does this affect you? Well, if you have any loans with adjustable rates such as a HELOC or credit card debt, you'll start to see interest rates rise on those. If you have a variable rate loan, you'll maybe want to consider refinancing right now into a fixed rate. But in general, 0.25% doesn't cause too much for concern, being that adding that much to a $40,000 loan only adds about $5 a month to your total bill, or $300 over the life of a 5-year loan. That's it for 4 stories. The news doesn't end here. Follow PropLogix on social media. Subscribe to the show on any of your favorite podcast platforms. Watch behind-the-scenes footage on YouTube. And if you have any feedback or want to be a part of the show, you can email 4.stories@proplogix.com. I'll see you in 2 weeks because we're taking a short break. Happy St. Patrick's Day.